This 3 dividend ETFs portfolio will surpass your full-time job. With $10,000 in hand right now, there are probably a lot of ways you would like to spend that money, but there is a smarter option you probably didn't think about. That $10,000 could be a seed that pays you almost $8,000 every month. That's the power of dividend ETFs. Today we are breaking down dividend ETFs and revealing 3 best funds from good to the best that can turn a simple $10,000 investment into a 6 or even 7-figure portfolio. No stock picking, no day trading, just steady, reliable income. The longer you let them grow, the bigger the payday. Without further delay, let's dive in. Investing in dividend ETFs is like putting your money on autopilot while still getting paid. The best part? They provide a steady income stream with dividends rolling in monthly or quarterly. Whether the market is booming or crashing, that's real cash flow you can count on. Then there's diversification. Instead of risking it all on a few stocks, these ETFs spread your investment across dozens, sometimes hundreds, of solid dividend-paying companies. If one struggles, the others help keep your portfolio steady. And let's talk stability. Dividend ETFs focus on well-established businesses that have been through recessions, market crashes, and economic chaos, all while continuing to reward investors. That's the kind of reliability you don't always get with high-flying growth stocks. Whether you're after passive income, long-term wealth, or a stress-free way to invest, dividend ETFs make it simple. So let's dive into the first dividend ETF. DVY. You could think of the iShares Select Dividend ETF, or DVY for short, as a curated playlist of top tracks. But instead of songs, it's packed with high-dividend U.S. companies. Its game plan? Handpicking around 100 solid U.S. stocks that have a track record of dishing out dividends. This strategy ensures you're not just betting on a one-hit wonder, you're spreading your vibes across a mix of industries. Now, let's talk about the lineup. DVY's portfolio is like a balanced mixtape, carefully curated for stability and growth. Utilities take the lead, making up 27.04% of the mix, providing a steady defensive foundation. Financials follow closely at 21.10%, bringing strong dividend payouts from banks and insurers. Looking at the top holdings, you'll see some familiar names. Altria Group leads the pack at 3.22%, alongside telecom giant AT&T, 2.16%, and tobacco powerhouse Philip Morris International, 2.12%. There's also a mix of industrial and energy players, like International Paper and Dominion Energy, reinforcing DVY's income-focused strategy. This blend ensures that even in market turbulence, DVY keeps delivering reliable dividends, making it a solid choice for income-focused investors. And here's the beat you'll love: the dividends. DVY boasts a dividend yield of approximately 3.57%, meaning for every $100 you invest, you could get around $3.58 back annually just from dividends. Over the years, these dividends have been grooving upwards, with a growth rate of about 10.38% per year. Plus, the share price has been dancing to a tune of a 9.30% annual return. So let's put these numbers to the test. If you invest $10,000 in DVY and hold on to your investment for 5 years, your portfolio could grow to around $18,500. That means your dividends alone would be bringing in about $700 per year. That's not exactly life-changing, but it's a nice little bonus just for letting your money sit there. Now, fast forward to 20 years. This is where things start to look really good. Your portfolio could be worth over $142,000, and the dividend income jumps to $7,800 per year. At this point, your dividends could cover a car payment, groceries, or even part of your rent, all without you lifting a finger. But here's where it gets crazy. If you let this investment ride for 30 years, your portfolio could balloon to $676,000, and the yearly dividend income? A whopping $50,000 per year, or about $4,100 per month. That's a full-time salary for a lot of people, purely from dividends. Clearly, DVY can turn a modest $10,000 investment into a serious income machine over time. Think it's worth it? Wait till you see even bigger returns that could be achieved with HDV. The iShares Core High Dividend ETF, or HDV as it's commonly known, is a fund packed with U.S. companies that not only pay high dividends, but also have solid financial health. It's designed to give investors a steady income stream by focusing on firms that consistently share profits with shareholders. Now, when we look at HDV's lineup, it's a bit more concentrated than some other funds. The top 10 holdings make up about 52% of the entire portfolio. This means that a significant portion of your investment is tied to these major players. Sector-wise, HDV leans heavily into energy, with ExxonMobil 9.85% and Chevron 6.54% leading the charge. Healthcare is another dominant player, featuring industry giants like Johnson & Johnson 6.35%, AbbVie 6.29%, and Merck 3.82%. Meanwhile, consumer defensive stocks such as Philip Morris, PepsiCo, and Coca-Cola add stability with their consistent cash flows. This mix is designed to provide both reliability and income, balancing out market volatility with strong dividend-paying companies from multiple sectors. Whether the market is booming or dipping, HDV's portfolio aims to keep the dividend checks rolling in. In terms of performance metrics, HDV offers a dividend yield of about 3.60%. Over the years, its dividends have grown at an impressive annual rate of 14.84%, driven by cash-rich sectors like healthcare and energy. This reflects HDV's focus on companies with strong cash flows, ensuring a steady and growing income stream for investors. The share price has also seen an annual return of around 8.20%, indicating steady growth. So if you're considering an investment of $10,000 in HDV, here's how it could potentially play out over time. If you keep reinvesting your dividends, in 5 years, your portfolio could grow to about $17,700, and you'd be earning roughly $700 per year in dividends. Not enough to quit your job, but it's free money just for holding on to your investment. Fast forward to 20 years and things get way more exciting. Your portfolio could be sitting at $130,000, and your yearly dividend income could be around $8,700. At this point, your dividends could easily cover a car payment, utilities, or even a portion of your rent, all without you lifting a finger. Now, if you're patient and let this ride for 30 years, your initial $10,000 investment could explode to $680,000, and the dividends? A whopping $66,000 per year, or $5,500 per month. That's full-on retirement money, just from dividends alone. But even good can be better, right? This next ETF will shock you. SCHD. Let's dive into the Schwab US Dividend Equity ETF, better known as SCHD. Just like the others, this fund is known for their solid dividend payouts and strong financial health. Its strategy focuses on selecting 100 stocks that have not only a history of paying dividends, but also exhibit quality and sustainability in their earnings. SCHD's lineup is well diversified across multiple sectors, with top holdings including Lockheed Martin, AbbVie, and BlackRock, each making up around 4% of the portfolio. This selection leans into a mix of defensive and growth-oriented stocks, balancing income generation with long-term appreciation. Sector-wise, financial services lead the pack at 20.24%, followed by industrials at 15.69%, and technology at 14.98%. Consumer defense and healthcare also play significant roles, making SCHD a well-rounded ETF designed to weather market fluctuations while maintaining strong dividend growth. Now, while all three ETFs aim to generate strong dividend income, their strategies differ. SCHD leans toward growth potential, with heavy exposure to financial services, industrials, and technology, sectors known for strong cash flow and long-term appreciation. HDV prioritizes dividend stability, concentrating on healthcare and energy, which are cash-rich but offer slower growth. DVY takes a more balanced approach, spreading its holdings across utilities and financial services to offer both income and diversification. Each ETF has its strengths, depending on whether you prioritize growth, stability, or a mix of both. Before we head to the projection, here's an overview of SCHD's metrics. For one, it offers a dividend yield of about 3.59%. Over the years, its dividends have grown at an annual rate of approximately 12%, reflecting the fund's focus on financially robust companies. The share price has seen an annual return of around 11.80%, making it the strongest performer among the ETFs we've covered. This highlights SCHD's advantage. Not only does it deliver solid dividend income, but it also offers impressive capital appreciation. That combination of growth and income makes it a compelling choice for investors looking to maximize long-term returns. Now, let's break this down and see how a $10,000 investment in SCHD could grow over time. In the beginning, it might not seem like much, but if you're patient and let the dividends do their thing, the results could be eye-popping. After 5 years, your portfolio could grow to about $20,700, and you'd be earning $700 per year. It's not life-changing, but that's already covering a couple of streaming subscriptions or a nice dinner every month without you doing anything. Fast forward to 20 years, your initial $10,000 could have turned into $220,000, and the dividends? A solid $12,000 per year. That's a pretty decent passive income stream, enough to help with rent, cover groceries, or even take a few vacations. But if you let it ride for 30 years, this is where compound growth really flexes its muscles. Your portfolio could be worth $1.3 million, and your annual dividend income could be around $94,000. Imagine that this translates to about $7,800 per month. That's not just extra cash, that's full-blown financial freedom. Of course, past performance isn't a guarantee of future results, but if anything, these projections highlight the power of compounding. The longer you stay in the game, the more the dividends work for you, creating a cycle of wealth that could pay off big time in the future. Investing might seem intimidating, but ETFs like DVY, HDV, and SCHD make it simple. The key is patience. Let your money work, reinvest those dividends, and watch compound growth do its magic. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already. And hit the notification bell so you don't miss out on future tips.